Welcome to The Explainer. Today, we're diving straight into exactly how you can legally protect massive W-2 income using hidden incentives built right into the U.S. tax code. We are talking about a strategy that literally turns your income into assets simply by following the exact instructions Congress wrote.
So, to set the scene here, I want you to imagine something. Picture this. You just received a massive $205,000 W-2 bonus at work. It's straight income. Now, for most high earners, an event like this instantly triggers a wave of panic about the massive tax bill that's coming. But now, imagine legally paying absolutely zero federal tax on that entire bonus. No offshore accounts, no shady shell companies, just the United States tax code, executed with the right structure and the exact right timing. It sounds totally insane, right? But as you're about to see, it is 100% possible.
Let's get into part one, the zero tax bonus, and how we escape top brackets.
We got to start by unpacking the main problem. How do we actually escape the brutal reality of top bracket taxes? Well, let's contrast the painful normal world against the short-term rental, or STR strategy. In the normal world, earning that big bonus drops you right into the top federal tax bracket. The IRS immediately takes 37 cents of every single dollar. That means you're losing over $75,000 before the money even hits your bank account. But with the STR strategy, you can generate active losses that legally offset that W-2 income. You see, the tax code isn't just about taking your money. It's basically a set of incentives. Congress actually rewards you for doing what they want, like investing in very specific types of real estate.
Moving on to part two, breaking the passive rule and escaping the IRS trap.
To pull this whole thing off, everything hinges on breaking out of a really specific, frustrating IRS trap. Normally, the IRS classifies rental income and losses as passive. This means any paper losses your rental property generates are stuck in a box. They can only offset other passive income. So they are completely useless for offsetting your active high W-2 salary. If you generate a massive loss on a regular long-term rental, it just sits there, suspended. It completely kills the strategy.
But here is the exact legal workaround. This is the precise IRS code, Treasury Regulation 1.469-1T, that unlocks the vault. It explicitly states that if your average guest stay is 7 days or fewer, your property is no longer classified as a passive rental activity. Just like that, boom, it's not passive anymore. Which means the losses it generates are now active, and active losses absolutely can offset your W-2 income. There's a catch, though, and this brilliantly illustrates what it takes to actually succeed here. To make those losses active, you absolutely must materially participate. You can't just buy a beach house and forget about it. You either need to spend over 500 hours a year managing it or participate more than anyone else, say 200 hours, as long as your property manager isn't working more than you. And most importantly, you must obsessively document your hours in a contemporaneous daily time log as they happen. Skip this step and, well, you lose.
Which brings us to part 3, the depreciation engine and front-loading deductions.
Now that our property's losses are considered active, let's explore the real engine of this strategy, generating massive paper losses without actually losing any real money. Normally, the IRS makes you slowly depreciate a residential house over 27.5 or 39 years. You get a tiny, honestly unimpressive tax deduction each year, but we don't do that. Instead, we use something called cost segregation. This is where you hire a qualified engineer to break the property down into its raw components and assign them shorter useful lives, like 5 or 15 years. This completely changes the game by letting us heavily front-load our tax deductions into year 1.
Think about it like this. A house isn't just one giant asset. When you buy a $1 million property, you're actually buying about $170,000 in 5-year personal property, like appliances and flooring. You're buying $80,000 in 15-year land improvements, like driveways and fences. You have a $600,000 structure and $150,000 in land. And land, by the way, cannot be depreciated. But by carving all these out, we can radically accelerate the depreciation on those 5 and 15-year items.
Okay, part 4, stacking the numbers and creating those massive paper losses.
Let's actually run the math on that $1 million property so we can see exactly how to shelter that entire $205,000 bonus. For 2025, Congress allows a 40% bonus depreciation on short-life assets. So taking 40% of our 5 and 15-year property yields massive deductions right out of the gate, $68,000 and $32,000. But the absolute kicker is the furnishings. If we spend $150,000 furnishing this high-end short-term rental, we can use Section 179 to deduct that entire cost in year 1. Add in the straight-line building depreciation, the cost seg fee, some mortgage interest, and suddenly we've generated an unbelievable $282,385 in total year 1 tax deductions.
And here is where the magic happens. Your deductions of roughly $282,000 far exceed your $205,000 bonus. So, what happens to those extra losses? They don't just disappear. Those excess losses actually spill over to shelter your regular base salary. So in total, you save the $75,850 you would have owed on the bonus. Plus, you get around $28,000 back from taxes you would have paid on your salary. This strategy literally puts over $100,000 directly back into your pocket in year 1 alone.
Part 5. The tax-free exit. This is all about keeping the wealth.
So the crucial question here is what happens down the road, right? How do you actually exit this investment without owing a massive tax bill on all that depreciation? Well, we close the loop by, frankly, never selling. In year 1, you shelter your massive W-2 income. Over the next few decades, the property generates an estimated $30,000 in net positive cash flow annually, all while appreciating in value. And the grand finale? When you pass away, your heirs inherit the property with what's called a stepped-up basis. This means the IRS resets the property's value to its current market price, legally wiping out all the depreciation recapture. You reap the tax benefits while you're alive, and your family inherits the asset entirely tax-free.
Now for Part 6, the reality check. We need to talk about the strict rules of the game.
Before you rush out to buy real estate, let's pause for reality check. Because if you try to fake this, you will lose, and lose hard. This is a rigorously documented business. The IRS actively audits short-term rental losses. If you don't have a contemporaneous time log, your losses revert to passive, and you will owe back taxes and penalties. Plus, you must legitimately operate a short-term rental with average stays under 7 days. You can't just rent it out to your cousin for 3 months. You absolutely need a specialized CPA, not just a generalist. And finally, keep an eye on legislative risks. Bonus depreciation percentages change, so the math fluctuates depending on the year you execute this strategy.
So how do we turn all of this into an actionable game plan? Well, if you make over $100K in W-2 income and have the capital to deploy, here are the 6 exact steps. First, find a great property and immediately hire a specialist CPA. Second, commission a cost segregation study the second you close. Third, you must purchase and install all your furnishings by December 31st of the tax year you want the deduction in. That ticking clock is very real. Fourth, log every single participation hour daily. Fifth, run a genuine short-term rental business. And sixth, ensure your CPA files your return with all the complex selections and studies properly attached.
Ultimately, you guys, this strategy isn't some shady loophole. It is a very deliberate choice to build the exact housing and tourism infrastructure that Congress actively wants to exist. They put the incentives right there in the tax code. The rules are written. The only question left is, are you going to put in the work to read them and take advantage of them? Thanks for tuning into this explainer. Keep learning, keep structuring, and we'll see you next time.